Today, in the shadow of inversion. Hello again, it's Martin North from Digital Finance Analytics. Well, now this post is covering finance and problem news with a distinctively Australian flavour. Welcome to our latest weekly market update as we survey the action in the US, Europe, Asia and Australia. And we'll also be touching on oil, gold and crypto as we progress. I find that by looking across the markets like this, it really helps me to organise my thoughts about what is really going on. Investors begin a new quarter wondering if the fighting in Ukraine, the isolation of Russia, and the Fed's increasingly hawkish turn will engender still more volatility and losses for stocks and bonds. As the bets of aggressive Fed action continue to be priced into markets, fears are growing that the Fed may slow growth by too much and tip the economy into recession. The US yield curve extended its recent flattening as Treasury yields, which retreated earlier in the week as portfolio adjustments boosted demand for bonds, spiked again on Friday, causing a closely watched part of the yield curve to invert for the third time this week. The yield on the 2-year Treasury bond got to 2.4625%, and that jumped above the yield on the 10-year Treasury note at 2.389%. An inversion of the yield curve, where shorter-dated yields rise above longer-dated ones, is seen as a harbinger of a recession in the next 1 to 2 years, and it's actually pretty reliable. The dollar gained as US payrolls slightly missed expectations, and the March unemployment rate fell to 3.6%. Meanwhile, an ISM manufacturing survey disappointed with higher than expected prices paid. It's officially the first week pointing consistently towards a slower economic activity worldwide, said Florian Aleppo, head of macro at Lombard Odier Asset Management. He said positioning signals are on the bearish side, and an internal model of his is showing a consumption slowdown could hurt earnings across the second quarter. That said, US equities advanced in the final minutes of trading, and US yields surged on Friday as the solid US jobs report buttressed the Federal Reserve's case to use aggressive interest rate hikes to tackle inflation. The buying came after a report showed that the economy added 431,000 jobs last month, bolstering overall optimism about the outlook and the case for higher interest rates. While the headline jobs number missed, the jobless rate fell to 3.6%, and wage gains accelerated, according to the data from the Bureau of Labour Statistics. Economists had been looking for about 490,000 on payroll and 3.7% for the jobless level. A jobless rate of 4% and below is generally defined by the Federal Reserve as full employment. The United States has technically had full employment since December, when the jobless rate fell to 3.9%. An alternative measure of unemployment, which includes discouraged workers and those holding part-time jobs for economic reasons, fell to a seasonally adjusted 6.9%. That's down 0.3 percentage points from the previous month. The moves in the jobless metrics came as the labour force participation rate increased 0.1 of a percentage point to 62.4%, to within 1 point of its pre-pandemic level in February 2020. That growth by 418,000 is now within 174,000 of the pre-pandemic state. Average hourly earnings, a closely watched inflation metric, increased 0.4% in the month, in line with expectations. On the 12-month basis, pay rose nearly 5.6%, just above the estimate. The average work week, which figures into productivity, edged down by 0.1 hours to 34.6 hours. All in all, nothing shocking about this report. There was nothing that was really surprising, said Simona Mokata, chief economist at State Street Global Advisors. Even if this report came in at zero, I would still say this is a very healthy labour market. Today's solid growth of payrolls checked the box for the Fed in its drive towards fighting inflation, said Rick Reeder, BlackRock's chief investment officer for global fixed income. Consequently, the Fed looks clearly undeterred in reaching at least policy neutrality and probably will do so at least once and maybe two 50 basis point hikes by the June meeting, which could even include an inter-meeting hike. Bill Adams, chief economist for Comerica Bank, said March's robust jobs growth in the March report will stiffen the Fed's resolve to normalise monetary policy in a hurry. And they forecast the Fed to raise the federal fund rate by 0.5 percentage point at both their next two meetings in early May and mid-June. On Wall Street, shares had turned to modest losses late, after modest gains earlier, and then turned higher into the closing bell. Real estate, consumer staples and utilities paced 8 of the S&P 500's 11 industry sectors higher. The laggards were industrials, financials, and information technology. The Dow Jones Industrial Average rose 0.4%, the S&P 500 added 0.34%, and the Nasdaq Composite gained 0.29%. Bank stocks struggled to cut losses as an inverting yield curve depresses their margin on lending and limits growth. Firms such as SVB Financial, Fifth Third Bancorp, and Regions Financial were the biggest decliners in the sector. Tech was once again in the crosshairs as semiconductor stocks struggled to catch a break on Wall Street. Qualcomm fell more than 3% after JP Morgan ditched the chipmaker from its analyst forecast list, and in other news, GameStop eased gains to trade 1% lower after the video game retailer said it would seek shareholder backing at its next shareholder meeting to split its stock. And more broadly, US stocks suffered their worst quarter in 2 years in the first quarter, as a downbeat January and February offset gains in March, but some see the recent rise in stocks will still continue ahead. This current equity weakness is a brief pause before extending the rally that began around March the 16th. January Montgomery Scott said, "Equities are a real asset as they make a claim on nominal GDP, according to the market ear. In the post-financial crisis era, weak economic activity and low inflation pushed down nominal GDP, raising the equity risk premium, reducing the bond term premium. So as long as economies grow, revenues and dividends should also grow. The dividend yield can be thought of as a real yield. Equity risk premia have started to decline in the post-COVID cycle, but remain higher than in the pre-financial crisis era." But others, pointing to the curve inversion, suggests more falls ahead and that we're simply in dip buying territory. Given its impressive track record in predicting US recessions, it's been almost 50 years since the last false positive. It would seem foolish to doubt that there is bearish recession speculation out there, said Paul Ashworth, chief North American economist at Capital Economics. Either way, the VIX is lower, down 4.5% to 1963. Raw materials are the only key asset class to deliver major gains so far in 2022, as global stocks finished the quarter with their first loss since the pandemic bear market. Oil longs were staring at their worst week, though, in 2 years on Friday, as trading for April began with US crude settling below the key $100 a barrel support level, and there were big gains for the first quarter already in the rear window. London traded Brent, the global oil benchmark, settled down 32 cents or 0.3% to 104.39 per barrel after a session low of 102.37. Week to date, Brent was down 13%, its biggest weekly decline since April 2020. On Thursday, it finished the first quarter up 39%. New York traded US crude benchmark West Texas Intermediate, or WTI, settled down $1.01 or 1% at 99.27 a barrel after an intraday low of 97.81. WTI was down almost 13% on the week for its biggest weekly drop since April 2020, and on Thursday it settled first quarter trading up 33%. The Biden administration announced on Thursday that it would release a record of 1 million barrels per day of oil from the US Strategic Petroleum Reserve, or SPR, over the next 6 months to alleviate a global supply crunch. Analysts across the sector warn of a worsening supply crunch in the coming months as the United States upholds its ban on Russian oil, while many other nations avoid business with Russia as well due to sanctions imposed against Moscow over its war in Ukraine. Despite such warnings, the world's biggest oil exporters in OPEC, along with their allies, which include Russia, decided on Thursday to do just a modest production increase for next month. The wider oil producers alliance known as OPEC Plus said it would increase output in May by 432,000 barrels a day. That's a slight uptick from its typical monthly increment of 400,000 barrels a day in a market analyst said would need more than 5 million barrels more. OPEC Plus also said on Thursday that the recent volatility in oil prices was not caused by fundamentals, but by ongoing geopolitical developments, in an apparent reference to the war in Ukraine. Brent hit 14-year highs of almost $140 a barrel in the aftermath of the sanctions imposed on Russia and have largely held above $100 over the past month. Amos Holstein, a Biden administration's special envoy for international energy affairs, said on Friday that the 180 million barrel release from the SPR was just the beginning of more such supply that would come on board. I believe that we're going to have additional capacity coming online from our allies, Holstein said. There's a meeting that is going on right now of the IEA, the International Energy Agency, to look at additional releases from the international markets. So we won't just have oil coming on the market in the United States, but rather have oil coming online to the markets in Asia, as well as Europe, over the next several months. But energy market analysts appear skeptical of the plan's success. The knee-jerk sell-off from the SPR announcement of the release of 1 million barrels a day from the SPR over the next 6 months won't have a lasting impact on oil prices. So if geopolitical risks continue to intensify, oil will recover most of this week's losses, said Ed Moyer, analyst at online trading platform Onda. Biden ordered the release of 50 million barrels from the SPR in November and 30 million last month, in coordination with the reserves released by other countries that include China, Japan, India, South Korea and Britain. The SPR has 568.3 million barrels in its stock as at the week ended March 25th, according to the US Energy Information Administration. With the current released plan of 180 million barrels over the next 6 months, the nation's reserves would be drawn down to a third of its current size. Biden began tapping the SPR to provide US refiners with oil loaned from the reserve that they wouldn't have to pay for, but return within a stipulated period. By doing this, the administration hopes there will be fewer transactions of oil in the open market, and prices for both crude and fuel products like gasoline and diesel would come down. In recent weeks, the administration has released some 3 million barrels weekly from the SPR, but the government's effect have had a minimal effect so far on prices, with refiners turning out more products than they usually do at this time of year, resulting in extraordinarily high usage that has kept prices little changed on both the crude and oil products fronts. And separately, the Transportation Department announced on Friday that US-made cars are to deliver a fuel efficiency of 49 miles per gallon from 2026 versus the existing 35 miles per gallon requirement as the Biden administration speeds up reductions of fossil fuel consumption amid near record high pump prices of above $4 per gallon. And Biden also announced on Thursday his administration's intent to invoke Cold War-era powers to boost domestic output of critical metals and minerals for the making of electric vehicles and the batteries to power them. Declines in oil prices moderated on Friday as the UK is expected to join the US in releasing more oil from its reserves as part of an effort to lower prices and reduce reliance on Russian supplies. Russia's Gazprom has started telling clients how to pay for gas in rubles, and meanwhile, European Union leaders said they told China they expect the country to help persuade Russia to end the war. Russian stocks, though, gained for a third day, the longest winning streak since trading resumed on March the 24th, as talks between Ukraine and Russia resumed. Russian Foreign Minister Sergei Lavrov said Moscow is preparing a response to Ukraine's proposals on ending hostilities. So far, the Russian government has stayed current on its debt obligations, by the way. JP Morgan Chase & Co. processed nearly $447 million of payments for dollar debt due in 2030 on Thursday. Another deadline is approaching on April the 4th. Now, London's FTSE 100 rose on Friday and marked its fourth consecutive weekly gain, with consumer staples and miners leading advances, while sports goods retailer Frasers jumped after unveiling a new share buyback plan. The blue chip FTSE 100 closed higher, with Reckitt Beckhamston Group climbing 3.1% after Barclays raised its price target on the Lysol cleaning products maker's stock. Other consumer staples, including Unilever and Diageo, were among the top gainers, benefiting from a weaker pound. I don't think that the actual rally in equity prices is sustainable, but I still believe that the FTSE 100 is in a better position to outperform the European and US peers due to high exposure to energy and commodity prices, said Ipek Ozakaria, a senior analyst at Swissquote. For now, the best place to be in for investors is still oil and energy-related investments, even though we may see a downside correction after such a strong rally over the past couple of weeks. The FTSE closed up 0.3% to 7,537, and it's risen 2.1% so far this year, compared with a 5.9% drop in the Pan-European Stock 600 and a 4.8% fall in the US benchmark S&P 500 index. Miners rose more than 2.1%, with Rio Tinto, Glencore and Anglo American up between 1.3% and 2.6%. And the London Metal Exchange suspended deliveries of some Russian-produced metals into its approved warehouse in Britain, although there is none stored in there at the moment. The domestically focused mid-cap FTSE 250 index advanced 0.3% on Friday, with Bridgeport Group up 3.8%, among top gainers after Citigroup upgraded the stock to buy from neutral. Frasers gained 3.5% after announcing a new £70 million share buyback plan. European stocks traded in a mixed fashion on Friday, with investors cautiously monitoring fresh negotiations aimed at ending the war in Ukraine, the spat between Moscow and European nations over the payment of Russian gas, and key Eurozone inflation data. DAX in Germany closed 0.22% higher at 14,446, while the CAC 40 in France rose 0.37% to 6,684. European equities rebounded on Friday after the region's stock markets suffered their biggest quarterly loss since the start of 2020, with the Russian-Ukraine war and the associated surge in commodity prices raising concerns of a recession. Peace negotiations continued by video conference on Friday, but previous talks have achieved very little, and the Ukrainian president warned on Thursday of battles ahead in Donbass and the besieged southern port of Mariupol. Russia claimed 2 Ukrainian military helicopters crossed its border and attacked an oil storage facility in the city of Belgorod, which, if true, would be a significant escalation in Ukraine's effort to slow the Russian invasion. Ukrainian authorities did not confirm the allegations, though. And the Russian president said on Friday that Moscow would continue supplying gas to Europe, easing fears that he would order a halt of supplies unless Western governments paid in rubles, something that they'd refused to do. Russia supplies about a third of Europe's gas, so the removal of this would likely result in a full-blown energy crisis. The European economic data slate included manufacturing PMI numbers for Germany, the region's manufacturing hub, following on from the Caixin Manufacturing Purchasing Managers Index in China, falling to 48.1%. That's the steepest rate of contraction since February 2020. Inflation in Europe is also running at record levels, with Euro data inflation hitting 7.5% in March, according to data released on Friday, another all-time high, with months left before it is set to peak, raising pressure on the European Central Bank to act to contain prices, even as growth slows sharply. The European Central Bank chief economist Philip Lane on Friday said very high inflation in the region was there, and that the Frankfurt institution might have to think again about its policy stance. Headline inflation has broken new records recently, having stood at 5.9% in February. Moreover, experts estimate inflation will rise even higher going forward. In terms of our sequence, the first decision will be if the medium-term inflation outlook is maintained. We would be looking at ending net asset purchases in the third quarter, Lane said, regarding its current policy trajectory and the removal of pandemic-era stimulus. However, if the outlook deteriorates by so much that the inflation outlook weakens, then we'll have to think again, he added. The ECB had announced last month that it would end its quantitative easing program in the third quarter, given higher inflationary pressures. However, the central bank is seen as being at a crossroads as Russia's unprovoked invasion of Ukraine has brought new economic challenges, notably pushing up energy and food prices. As such, one of the dilemmas that the ECB faces is how to address massive inflation levels while also taking into account slow economic momentum. We have opposing forces, Lane said. We have the energy shock at the prospect of second-round effects pushing up inflation. On the other hand, the weakening of sentiment and the fact that real incomes will suffer with the high energy prices, especially over a kind of 1 or 2 year horizon, will have a negative pressure on the inflation outlook. And he added that as a result, there will be a lot of work, a lot of analysis, a lot of debate about the net impact of those opposing forces. The Pan-European Stock 600 index climbed 0.54% and the MSCI gauge of stocks across the globe rose 0.16%. And in response, the German 10-year government bond yield, a benchmark for the Eurozone, rose 2.8 basis points to 0.58% after jumping 39 basis points in March, its biggest monthly rise since 2009. Government bond yields have moved up markedly in recent weeks and can be expected to trend higher over time due to inflationary pressures that are here to stay and responses by the main central bank. Christian Nottling, Global Chief Investment Officer at Deutsche Bank Private Bank, said in a note. Now over in Asia, in Tokyo, the Nikkei was down 0.56%, registering a 1.7% weekly fall to 27,665, as supply chain disruption and surging raw material costs drove Japanese business confidence to a 9-month low last quarter. Data showing the Tankan Large Manufacturers Index at 14 and the Tankan Large Non-Manufacturers Index at 9 for the first quarter of 2022. The Nikkei volatility, which measures the implied volatility of the Nikkei 2-5 options, was down 3.66% to 22.37. That's a new 1-month low. China's worst COVID wave since the initial shock of the pandemic has cut into annual revenue projections for roughly half of American businesses in the country, a survey showed that was released on Friday. The Beijing-based American Chamber of Commerce in China and its Shanghai counterpart surveyed 167 members operating in China, including 76 manufacturers this past Tuesday and Wednesday. The metropolis of Shanghai, where many foreign businesses are located, entered a 2-part lockdown this week as municipal authorities sought to control a growing number of COVID cases. Those measures followed shorter lockdowns in the tech hub of Shenzhen, the manufacturing hub of Dongguan, and travel restrictions across the country. The survey found that 54% of respondents have lowered 2022 revenue projections for the year due to the latest COVID-19 outbreak. Among manufacturers, more than 80% reported slowed or reduced production, as well as supply chain disruptions, and nearly all, 99%, of respondents said the latest outbreak had affected them. Since the pandemic began in 2020 and China tightened restrictions on international travel, foreign businesses in China have complained of long quarantine requirements upon arrival and difficulties of bringing in senior management or technical staff. If China's current COVID-19 restrictions remain in place for the next year, half of respondents to this week's CAM survey said they would reduce investment, and nearly 75% of respondents said maintaining those restrictions would reduce their revenue and profit. And nearly 20% of manufacturers said they would move manufacturing or operations out of mainland China if the COVID-19 restrictions remained. While just about half of respondents overall were satisfied with China's efforts to control COVID spread, the top 3 aspects of dissatisfaction were length of required quarantines, restrictions on travel to China, and the lack of flights to China. The top 3 recommendations from survey respondents were to allow for home quarantine or other options, simplify requirements for coming to China, and allow more flights into the country. The number of new COVID cases and deaths reported in mainland China remain well below that of major countries. The Caixin Manufacturing Purchasing Managers Index for March was 48.1, with National Bureau of Statistics data from the day before showing that the manufacturing PMI was 49.5 and the non-manufacturing PMI was 48.4. Though Shanghai was up 0.94% on Friday to 3282, while the Hang Seng in Hong Kong lifted 0.19% to 20,039. Downgraded growth outlooks in the US, Europe and China are something to watch very carefully, Columbia Threadneedle Investments head of multi-asset strategy, Amawiti Bahagana, told Bloomberg. There are very few places to hide these days in the mid-asset space, though commodities are a good spot because of inflation and geopolitics, she added. Yet, Safe Haven Gold fell 0.76% after its biggest quarterly gain in 2 years. Spot gold was last quoted at $1,923 per ounce. Gold began April trading with a fairly large slide on the week as the US unemployment rate fell despite an underwhelming monthly addition in jobs that suggested the economy might not fare too badly, reducing the need for investors to rely on safe havens. The front-month gold futures contract on New York's COMEX settled down $30.10, or 1.5%, to $1,919. For the week, it fell 1.8%, its second biggest weekly decline in 3, that contrasted with its first quarter gain of 6.6%. Gold typically serves as a hedge against economic and political troubles. In March, COMEX front-month contract got up to as high as $2,070. That's just $42 from rewriting below its August 2020 record high of $2,121 amid turbocharged US inflation and a babbling of geopolitical tensions right after Russia's invasion of Ukraine. The shorter end of the yield curve is steepening, and while recession risks for down the road are growing, the economy is still looking very good right now. Ed Moyer said, gold seems like it could still trade between 1,900 and 1,950, but the risks of bearish momentum winning out are growing. Now, here in Australia, the Australian share market rose for a third straight week on Friday as strong gains from the mining sector helped local shares offset their year-to-date losses. The ASX 200 rose 87.6 points, or 1.2%, to 7,493 this week, despite dipping 5.8 points, or 0.1% on Friday. While the budget grabbed headlines during the week, the reaction on the local share market was muted as investors instead focused on geopolitical concerns, driving iron ore higher and oil prices lower. Or could it be that the markets realised that there was very little in the budget other than a bit of smoke and mirrors? BHP Group led the market, contributing to almost half the gains alone. As iron ore and base metal prices pushed higher, its shares rose 5.3% to 52.39. Rio Tinto added 3% to 120.34. Fortescue Metal Group advanced 9.3% to 21.06, and Champion Iron Ore firmed 7.7% to $7.81. South 32 climbed 4.1% to 5.31, and IGO advanced 5.3% to 14.41. Lithium miners were also strong during the week, as Allkem reported record pricing ahead of the June quarter. Mineral Resources climbed 12.1% to 54.59. Allkem climbed 12.6% to 12.40. Pilbara Minerals firmed 6.9% to $3.43. And AVZ Minerals rose 14% to $1.30. Tabcorp shares climbed 9.1% to $5.50 as the company began to pitch its $11 billion demerger plan to shareholders, despite Racing New South Wales threatening to scuttle the deal. Tech stocks also found some buyers during the week, helping the sector recover from a tough few weeks following on from a massive sell-off in the bond market. Novanix soared 16.1% to $6.41. Life 360 advanced 10% to $5.74. Megaport climbed 6.3% to $13.84. And NextDC firmed 6.8% to $11.81. The major banks were mixed during the week. NAB firmed 2.1% to $32.33, while Westpac advanced 0.8% to $23.95. ANZ fell 1.6% to $27.18, and Commonwealth Bank dropped 1.3% to $104.53. Energy companies were among the worst performers as the price of oil slid amid fears demand could be curbed by lockdowns in China and the largest releases from strategic reserves in US history. Woodside Petroleum dipped 2.7% to $32.68. Santos slid 0.5% to $7.90. And Beach Energy declined 4.3% to $1.56. And so to crypto, where Bitcoin returned to above $45,000 US on Friday as volatility faded. Alternative cryptocurrencies, altcoins, were also higher, especially AAVE, which posted a 20% gain over the past 24 hours and up 60% over the past week because of the platform version 3 upgrade earlier this month. Ether was up 4% in the past 24 hours, compared with a 9% rise in Solander's Sol token and a 1% rise in Bitcoin over the same period. In the Bitcoin futures market, an uptick in short liquidations occurred over the past 24 hours because of the cryptocurrency's price jump. Liquidations occur when an exchange forcefully closes a trader's leveraged position as a safety mechanism due to a partial or total loss of the trader's initial margin. Still, the sell to buy volumes was slightly negative on Friday, indicating low conviction among crypto traders despite Bitcoin's price rise. Bitcoin's trading volume across major exchanges remained relatively low, according to CoinDesk data, despite trading activity tending to increase around the first and last weeks of the month. This chart shows large volume spikes, which typically occur during price drops. Some analysts notice that Bitcoin tends to decline around the beginning of the month before a recovery unfolds, similar to what occurred in February and March. And this chart shows a decline in the Bitcoin put-call ratio, which suggests less bearish sentiment among options traders. The ratio stabilized over the past 2 weeks, which could precede higher volatility, especially if Bitcoin breaks above or below its short-term trading range. The options market is placing a 55% probability that Bitcoin will trade above $44,000 US in May, according to data provided by Skew, and calls outweigh puts at strike prices above $45,000. And finally, US Senator Elizabeth Warren says it's time for the US to create its own central bank digital currency, or CBDC. So a lot that banks do wrong, if you think we could improve that in a digital world. The answer is sure, you could, but in that case, let's do a central bank digital currency, Warren said. Yes, I think it's time for us to move in that direction. And on whether Bitcoin will face at minimum being regulated like a commodity, Warren responded, I think it's going to end up getting regulated, using the subprime mortgage financial crisis that started in 2007 as an example of why it's needed. She didn't say, though, what form such regulation might take. And in March, Warren announced a new bill to block cryptocurrency companies from conducting business with sanctioned companies. The Digital Asset Sanctions Compliance Enhancement Act would allow the US president to add non-US based crypto companies to sanctions lists if they support sanctions evasion. And on whether the senator saw cryptocurrency as this decade's real estate bubble, Warren replied, the whole digital world has worked very much like a bubble works. What is it moving up on? It's moved up on the fact that people all tell each other that it's going to be great. Just again, like it was with the real estate market. How many times do people say real estate always goes up? It never goes down? They said it decades ago, before the last real estate bubble. They said it in the 2000s, before the crash in 2008. So standing back, you can see here that there is a lot of uncertainty still milling around. And the inversion of the yield curve, I do think, is significant. I think that there is a bit of dip buying going on at the moment, but the fundamentals look to me a bit shaky. So again, caution ahead is required. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.